Hello everyone, today is April the 22nd. Welcome to the first session of the Wyckoff Trading course part 1. This is an open class. We have today two groups of students, the students that have already signed up for the course and then our guest. For those of you that are new to our community, welcome. Today we will review the entire course curriculum and we'll also discuss as usual the current market outlook. Let's start. As usual, everything we discuss is for educational purpose only. Please stop the recording and read the disclaimer in full. My name is Alessio. I'm your teacher for this summer semester. I've been a member of the Wyckoff Analytics team since 2018. Since then, I've collaborated with Roman and Bruce on several projects. I conducted this class last year as well, and I have to say that we had a very passionate, committed group of students, so I can't wait to work with all of you this year. Here you can see our schedule for the semester. All sessions start at 3 p.m. Pacific time every Monday. Webinars will be recorded, so you can watch them later if you can join live. If you can't join our session live, you can still send me your exercise and questions for each session. I will personally review each exercise and I will send you my short feedback. Every student will have a profile page where you can find recordings, lesson slides, and homework. Speaking of homework, please submit your charts as a single PDF file, PowerPoint, or Word format. This is very important. Let's say that your assignment includes many charts. Please put them all together in one single file. This makes it much easier for me to review all this stuff. You can send your homework and questions to my email address right here, alessio.wyckoffanalytics. Today's session will last about 2.5 hours and will be posted on our YouTube channel. We have a payment plan that you can see right here of $332 per month for 3 months. And you can find this on our Wyckoff Analytics website. Alumni of Wyckoff Analytics pay $700. If you have any administrative questions, please contact Nancy at this address right here. Now let's talk about the curriculum. Let's talk about what we'll be covering in this course. So in the first 5 classes, we will explore Wyckoff structure analysis. We will study trading ranges and trading environments. And our goal is to be able, as a group, to recognize the early changes in the market. Price and volume always give you many clues, many important signals every time the market is shifting from the trading range environment to the uptrend and vice versa. Today, for example, we will review the early signs of deterioration that were visible in the market before the current correction that we are experiencing right now. And we began noting all these early signs, all these cracks in the uptrend about 3 weeks ago. You can find many clips on our YouTube channel, on Twitter, where we have analyzed all the subtle changes in price and volume behavior before the correction. Then we will explore the Wyckoff phases. So even if you're familiar with the Wyckoff labeling, we will study in depth many nuances together. In my experience, I've noticed that sometimes traders tend to apply the concepts in a mechanical way. How many times I've seen on social media, for example, an attempt to use the Wyckoff schematics just looking at the geometrical shape of the structure. For example, look at this. It looks almost identical to the Wyckoff structure. And then I see the picture showing a very simplified trading range. The truth is that there are many variations in the structure. So if you just focus on the shape of a trading range, you would be not able to recognize in real time dozens and dozens of variations. You have to focus on the principles behind the market structure. So each structure is the result of multiple forces, several kinds of traders, institutional traders, professionals, and even retail traders operating at the same time in the same market. And Wyckoffians know that each one of them leaves a signature on the chart. And we will talk about this today. So our goal, especially for the first part of the course, is to train our eyes to recognize these clues, think about the principles, extract the story behind the chart. And then we'll be able to recognize multiple variations of a structure. Next, from session 6 to 11, we will study volume and price analysis. I would say that learning to interpret volume is the core of this course. So we will have interactive exercises where we analyze charts bar by bar. And I will encourage you to participate. You can interact during this exercise. So we will cover topics like effort versus result, volume spread analysis, swing analysis, and look at many case studies related to volume patterns. Now, if you've been following our work for some time, you know that we love using historical analogs. We often identify structure from the past and then use them as reference points. This exercise is very valuable, and I can say that comparing one chart to another, you will learn to spot the common aspects and all the differences between one trading range and another trading range. And you can also compare the price action of today to what we've seen 1 year ago, for example, and we will see this in the current market outlook, a great example of that. Then we have right here a section devoted to comparative analysis, relative strength analysis, so session 12 and session 13. This is often underrated, but it's very crucial. Before looking for setups, we always have to identify the assets that are outperforming the market. And we will show you our filtering routine and some tools that we have developed to save time in the selection process. Then, moving on to session number 14, we will illustrate trade management through examples and discuss very important aspects like entry and exit points, stop loss placement, and so on. The final session will be totally devoted to answering any questions you may have. So it's a great opportunity to address any doubts that you can have throughout the course. For those of you that have completed WTC Part 1 or are considering enrolling, Part 2 focuses on the execution. This class is often called the practicum course, and tomorrow at 3 p.m. Pacific time, you can join Roman's open door class. So you will finally put in practice what you've learned through many exercises. And in particular, the bias games are very helpful. We always challenge our students to recognize patterns of accumulation and distribution through a series of simulations. We strongly believe in simulations, and I can definitely say that students see the benefit in this approach. So do not miss the open door session with Roman tomorrow at 3 p.m. Pacific time. It's free. You can register on our website or just watch the recording on YouTube later. Now let's talk about the curriculum. First, your homework. So your first assignment for today is to read The Anatomy of a Trading Range by Jim Forte. You can download the PDF from our website. This article is one of the best introduction to the methodology. It covers many basic principles in just 12 pages. It's written in a simple language. For this session, you just have to read this article, but in the next session, the assignment will be practical exercise where you have to label charts and refine your skills. So we will review the stock indexes, BTC, gold. I will show also our thought process on the current market conditions every week. So this is a common routine that we have. Next, we will discuss the concept of the composite operator, the CO, and I suspect that many of you have heard of this concept before. But today we will break it down and make it much easier to understand. Then we will study the price cycle model right here, and finally behavioral market analysis. Institutional investors with loads of cash have specific goals and needs, and their goals are different from the average retail investor. So if you're a retail trader, for example, your trading is not affected by the end of the quarter. You just think about your performance, your portfolio, and that's it. Institutional investors, on the contrary, have specific deadlines. Their goal is to beat the performance of the index every quarter. So these institutional managers move billions of dollars and tend to hold their position for a long time. And when they finally sell, they can't do that in just one single day. It's a process that requires several days, weeks, even months. So if you want to recognize the footsteps of these institutional managers, you have to understand their way of thinking, what rules are following, and so on. And we will study a real example today, a popular stock like Apple. Moving on to session number 2 next Monday, we will discuss the changes in character and behavior, accumulation, distribution. So we will spread all these topics over several sessions. So let me show right here your assignment for the first session. Another assignment, please visit your student profile page on the Wyckoff Analytics website, so your profile, and you will find a very short quiz. So it takes just 3 minutes. Don't be shy about your initial score. It's not important to me. What really matters to me is your growth throughout the course. So just a way to see your level of knowledge and so on. Another couple of announcements. If you're interested in the intraday trading, we have a special in May, and Roman will conduct 2 sessions totally devoted to intraday trading. As you can see in the curriculum here, the material is very well structured. So you will go through a specific sequence, pre-market, first bar, then first 60 minutes of the session. So if you want to be an intraday specialist, you have to be extremely disciplined. You can't trade without a plan. You have to be able to identify a change of behavior very quickly. So you have to be ready to use different strategies throughout the session. It's not by chance that the final segment of the special is devoted to the development of your playbook and also the mental landscape. You have to be flexible if you want to be an intraday trader. You have to adapt to the changing conditions of the market, and on the intraday time frame, the market conditions are changing very, very quickly. There is another special in June. This is the first time at Wyckoff Analytics that we discuss option strategy in depth. So Eric will conduct 3 sessions totally devoted to this topic. This is a beginner intermediate course, so even if you have no experience with options, you're welcome. And what I find personally exciting about this class is the fact that Eric will explain option strategy within the Wyckoff framework. So what does it mean? Let's say that you notice a change of character in the uptrend. This is the uptrend. Buying climax, automatic reaction, secondary test. So you're a Wyckoffian. You know that after change of character, you expect a trading range. So price will likely spend some time within the boundaries of the trading range. And there are option strategy based on the directionality of the move, but also option strategy that you can use to extract the profits when price is stalling in a small trading range like this. Another example, you can have an apex formation with contraction of volatility and volume. If you're a Wyckoffian, you know that at some point you will see an explosion of volatility. But maybe you are still uncertain about the direction of the move, continuation or breakdown. Well, option strategy, there are many option strategy where you can bet on the volatility itself. So the direction of the move is not important. What really matters is the increase of volatility and spread out of this consolidation. So you can combine sophisticated option strategy to the Wyckoff with the Wyckoff methodology, and that's very powerful. But now let's start with the market update, and this will be a regular routine for us in every session. So let's look at the first chart, S&P weekly. So let's start from the very, very beginning. First of all, I will conduct now a poll. So are you feeling bullish or bearish about this chart for the long term? I'm not talking about the short term, the long term. So please be ready to answer in the chat box. I want to see your comment, guys. I see the first comment, bullish, looks bullish, bullish again, bullish. Okay, let's continue, see. Short-term bullish, I see long-term uptrend. This is correct. Okay, that's great. So let's analyze this step by step. So the first question is, what's the environment since late 22? We have a big accumulation structure. Look at the demand that was coming in late September 2022. We have a light penetration on the support and contracts in the first months of 20, so right here, look at this. Even here in this area, the volatility is very, very low, especially after the first move to the downside, the second move to the downside, and then we are stalling here and making this consolidation at a higher level of the trading range. So basically, this contraction of volatility means that buyers are in control, and the environment is shifting from the trading range to the uptrend. So the oversold line of the channel is established. Right here, we can define the oversold line right here. First touch, second touch, third touch. This is the overbought condition. And then what happens? So we have this beautiful uptrend, and the most significant correction is this. So we penetrate the oversold line of the channel. This correction is quite deep. However, if you compare this reaction right here with other indexes like the Nasdaq, you will find that the Nasdaq was much flatter, slightly down sloping, so not deep like this. Now let's look at the increase of volume around this low right here. So you can clearly see that there is some demand coming into the market. So the participation, institutional participation, is increasing. And who is buying off the lows? These are contrarian buyers. These are not retail traders. So after all this contrarian demand, price quickly reverses. And look at this beautiful bar right here. So all the up bars are showing increasing spread, good momentum to the upside, and the velocity of the reversal is a function of all this demand that was coming off the lows. So is hidden demand. And after that, we have a very steep leg to the upside. So there are almost no pauses throughout this local uptrend that we have right here. We just have a small accumulation to the end of the year, and that's visible just on the daily chart, not on the weekly. So the fact that price has been able to overcome the long-term resistance right here and spend time above the two highs is a sign of strength for the long term. So we didn't have an instant rejection below the resistance. This is a very important concept. Instead of stopping right here, we are still committing above for multiple weeks above the resistance, and then supply comes back into the extreme overbought condition. And by the way, this is a logical place for a correction. It's very common to see price overcoming the all-time highs and then consolidating around the long-term resistance. So the market needs to digest the supply, and this usually happens through time. So what could we say about this current spot? We are just testing the mean of the channel right here, which usually acts as a short-term support. So we are very close to test this level. Supply has to be absorbed, and the absorption process can take several weeks. Now let's see the same structure on the daily perspective. So we are definitely in a correction. However, the first signs of deterioration were already visible in mid-March. So look at the high volume signature that we have right here. Just let me use the pen again. Okay, look at this. High volume. Sorry, I'm using the Nasdaq here. Just 1 second. Okay. So this is the daily picture, guys. Can you confirm that you are still seeing my screen? Please say yes or no. Okay, good. So we are definitely in a correction. However, let's look at what happens right here. So we have good volume, but no follow through to the upside. So basically, there is some supply stopping the uptrend right here. We have a deterioration on demand, then supply comes in again, And look at this. This looks like a sign of weakness in the context of a trading range, a local distributional trading range. And if you look at the PNF counts that Bruce has done in the previous weeks, we are very close to commit to the first target, to the downside. And generally, when we are close to the PNF target, we expect some form of short-term rally, some form of bounce from here. So we are still, as you can see, there's some demand that is coming in right here in this low. Finally, after several days of weakness, we are seeing right here a good tail, demand tail, with an attempt to reverse. The attempt to reverse, it's not so strong so far, but it makes sense to have at least an attempt to retest this area. However, when we look at the overall structure, we have to highlight the fact that this reaction is much weaker than this reaction. For example, look at this. We have increasing spread right here to the downside, and then an attempt to stop, continuation. The volume is quite average. Right here, we do not have any attempt to hold. So basically, the price shows the increasing spreads to the downside. All these bars are just very weak attempt on the intraday to stop the move. And we fall down with a lot of velocity. This move is very vertical. So the overall weakness of the chart is way more pronounced than what we're seeing here. And this suggests that it can take more time for the market, for the buyers, to digest the supply that was present here rather than this. And this comparative analysis will be very helpful in the future. We will see that this is one of the most powerful tools that we have. So what kind of scenario could we expect from here? The first scenario is to just have a rally from here, an oversold rally from the oversold condition, and then we can retest this area. And this could still be an LPSY in the context of a local distribution. And I think this is likely one of the most important scenario we have to consider. In case tomorrow's bar reverses and still continue to the upside, and we see good volume, at least for 1, 2, 3 days, 3 consecutive days, in that case, we could just have a trading range developing in this area. And that would be much more constructive for the short term. However, let's remember that this is a week, a very peculiar week with a lot of earnings, and many big companies are releasing their earnings. And remember that large capitalization stocks have a very significant weight on the market indexes. Now let's look at the Nasdaq. So I have to come back to the slide right here. So please guys confirm if you can see the chart of the Nasdaq. Okay, and in this case, the picture is very similar to what we're seeing in the S&P, but we have a shorting of the trust, which is very evident right here, here. Look, all this rally are deteriorating. So the result to the upside is becoming weaker and weaker. And when we compare the current reaction to the reaction we had in August, right here, the verticality is way more pronounced. The supply signature is higher, and on Friday's bar, yes, we had this attempt to pause. Look at the volume signature is one of the highest volume signature since August. So we definitely see an attempt to buy and sustain price around this level. However, the spread of today's bar is a bit disappointing. So we will have to see what kind of response we will have from here. So far, I think that we are in a potential swing reversal right here, which has to be confirmed at least about with a commitment about this bar. But the volume that we have is a bit disappointing. So expect some volatility this week. Next chart, the Russell. And this is a very interesting structure. So we had a very good rally in late 2023. Look at this, large up spreads sustained by increasing volume, good demand. Then in the first months of the new year, some supply was coming to the long-term resistance. So we had this first attempt to absorb it. And look at this, it looks like a classic reaccumulation, by the way. However, after all this absorption, price is barely able to overcome this long-term resistance. So we fail here, volatility increases, and now we are springing this local support. So this is the point where short sellers could take some profits off the table and wait for a pullback to get another low-risk point of entry, likely to the downside here for some time. So in the next days, our goal will be to observe the way price interacts with this line, how much momentum we could have from this here. We could even have a trading range right here, something like this. And this is a very crucial support. So it would be great to see a contraction of volume and volatility around this area for the Russell. In case we fail right here and the support breaks, we will likely see a way more pronounced reaction with an LPS in this area, for example. You could still have a last point of support as a higher low compared to the previous low. But we are still at the very beginning of this formation, so we have to be very, very patient. And we have to remember that the Russell index is generally very sensitive to interest rates. So the announcement of higher interest rates for longer by the Fed usually have a very deep impact on this index. Now let's talk about very interesting chart, crude oil. So price was testing the long-term overbought line right here. Look at the volume at the top of the trading range. Volume increases. Buyers are trying to push price to the resistance. So we have high effort to the upside, but the result is low. What does it mean? So it means that there is a force which is stopping the demand right here. So this is selling, supply coming into the market. On the intraday basis, we form a small apex right here, and then we have the final breakdown. And I think that price will likely spend some time in this area. So we have this support line right here, which is a support line, a potential long-term resistance, which could act as a new support. And it will be key to compare this interaction with the long-term supply line to the previous approach that we had in October. So far, this rejection looks less dramatic than what we had in October. So let's say that price spent time in this area, creating a consolidation like this, and then break to the upside this line. This would be the signal that the long-term downtrend has been invalidated. And by the way, if you look at oil stocks like Exxon, their market capitalization is now higher than many tech stocks. Even, for example, look at the chart of Exxon and Tesla. So there is a potential shift in the market between certain sectors toward oil stocks. And this will be extremely interesting for campaigners. And now, last but not least, Bitcoin. So supply has come into the resistance right here. And this was the first signs of some supply coming to the market. So after a very good rally, we are now in the consolidation phase. The volatility throughout this trading range is slightly increasing. Look at this reaction right here. What I don't like here about this consolidation is the fact that we have a lot of volume right here. We have a multiple demand taste, so there is some demand that is stopping the move. But the rally right here looks a bit weak. Look at the volume that we have. So we are creating this small updates. So in order to prove their strength, buyers need to push price above this level. This is really important because we had some hidden demand right here, but we don't know yet the quality of the demand coming in. Are these weekends that are trying to sustain price, but they are not able to push it above the resistance, or this is a more significant accumulation by institutions? So far, this is a big question mark. Our tactics is just to look for this local resistance defined by the open this bar, and then this resistance right here. If we fail right here, let's say that we have a couple of days of decreasing spread, something like this, and then we stall, we spend time in this area creating maybe lower highs, this would be a very bearish signal pointing to a breakdown and a correction into this area, which is a very important support. So bulls need to break this resistance in order to confirm this reaccumulation. And by the way, a period of consolidation, short-term correction would be still in line with what we have seen historically around the halving. Crypto funds generally accumulate Bitcoin before the halving, and then they take profits into the event. This is very common if you look at the previous year, the previous cycle. So this big rally into the event, there's some selling to the news, and for a couple of months, 3 months, we generally have a trading range or a correction. So institutions are basically buying the rumor and selling the news. And if you look at the altcoin market, we already have a very significant correction in play for many small caps, and this means that it will take time to absorb all that supply. If you're interested in crypto, I definitely recommend joining our crypto Discord group. We have many tools there. But now let's look at the Wyckoff market discussion. This class is totally devoted to an analysis of the current market condition. Every Wednesday at 3 p.m. Pacific time, Professor Bruce and Roman review the market, the indexes, the sectors, best industry groups, and finally, we have a selection of stocks which are showing strength. So I definitely recommend this class, and Bruce brings his vast knowledge about the business cycle. He has decades of experience in the industry as a technical analyst. institutional manager, and in every session he shares his insights. And let me say this, we have been dealing with inflation for 3.5 years, and Bruce began his career during another very extreme inflationary period, the late 70s. So he brings so many examples and stories from the time, and this has immensely helped us to navigate this big market shift. Also, another important aspect, there's always room for students to submit their chart in this class. Then, if you are mostly into cryptos, Roman and I have launched 3 years ago the Wyckoff Crypto Discord. So this is our offering totally devoted to the crypto space. So every week we host a 30 minutes webinar where we analyze the market conditions. And we generally start with the stock market indexes, then we review the tech sector, and finally cryptocurrencies. So we use a top-down approach. We discuss also the capital allocation. There are weeks where we want to play defense, weeks where we want to be more exposed, and we discuss all the tactics, the composition of the portfolio, how much risk we are willing to take every week. For example, the current allocation model is around 20-25%, so we don't want to be too much exposed, but this can change in the next weeks. And I also developed a scanner that can help you to find the best opportunities. So you can use that to calculate, for example, point and figure target. You can find trading range on the intraday chart. In addition to that, there's a chart where you can interact with fellow students, submit your charts, and I'm always happy to help the community. The subscription is very affordable, just $49 per month. You can visit Wyckoff Analytics for more information and then join the crypto Discord. And this is an example of an update, a flash update that I'm publishing on the group just today. I also edit the Wyckoff Market Report every Friday. Let's say that you are very busy, but you still want to follow the stock market, look for candidate. This is a very compact report, generally 8 or 9 pages. The first page is devoted to the index. Then I review the big caps, Nvidia, Microsoft, Apple. And you know, option traders love to operate on highly liquid stocks. But then we review around 12 to 15 stocks, including mid caps, more speculative instruments that are showing potential setups. Generally, we look for candidates that have good leadership, a reaccumulation, and then they are developing some form of continuation. So like reaccumulation right here, we can look for sprint setup, for continuation setup, and so on. But now it's time to talk about Wyckoff himself. For those of you that are intrigued by Richard Wyckoff biography, the way he was moving his first steps into the trading arena, we recommend you the work by Stella Joba. Stella was a panelist for the Best of Wyckoff conference a few years ago, so you can find her presentation on our website. So let's talk about his life. So Wyckoff was a trader, an educator. He spent his youth investigating the strategies used by big traders like Jesse Livermore and JP Morgan. He collected so many insights from the market insiders from this era, and then he organized this material into a method that could be learned by the public. He founded the magazine of Wall Street, which ran until 1934. I spent some time rereading his original writing and comparing his techniques to other traders of his time. And I have to say that one of his strengths was the fact that he was a very good risk manager. So he was able to stay in the trading business for decades. And if you look at the US market at the beginning of the past century, that was very similar to cryptos, with extremes, boom and bust cycles, high volatility. So even good traders of that era experienced high volatility in their portfolios. But Wyckoff was a very good risk manager, so he knew when to lock in gains, exit the market, go short, and so on. So this very exceptional risk management was proven by the fact that the readers of the magazine Wall Street were able, thanks to his work and suggestion, to survive the 1929 market crash. So Wyckoff wrote several books. Many of them are in the public domain today, but unfortunately, all these books describe a very different market compared to what we see today. So back then, the stock market had a very small number of participants and capital. It was also unregulated, similar to crypto today. So we can say that the rules of the game are the same after 100 years. The stock market has changed, it's evolved. There are now many indexes to monitor, hundreds of ETF, future contracts, global markets. And our goal, Wyckoff Analytics, is to keep up with what's happening today. So in this course, you will find a very modern interpretation of the methodology, and Bruce, Hank Pruden, Roman have interpreted many concepts based on what we see in today's market. Wyckoff himself wrote a course, which is now in the public domain, so you can download it for free. However, I would recommend this only to advanced traders who want to gain a historical perspective. It's inevitable that after 100 years, the material becomes outdated. So if you are starting to explore the methodology and you want to apply the method to this market, I would recommend beginning with a more modern interpretation. It focuses on the market of the last 30 years. Remember, if you begin with an incorrect approach, it can take twice as long to correct later on. Then this is a very important concept. So what's the CO, the composite operator? So we often abbreviate the name composite operator to CO. So when you say CO types, composite man, we mean the same thing. The term composite operators represent the group of traders who are on the right side of the market. So generally we are talking about large institutional investors, who have access to top-level research, real-time economic data, or specific information about the health of a company weeks or even months before the general public. Usually, when news become public domain, it's already too late for speculators to capitalize on that. So buy the rumor, sell the news. These institutions have immense capital to allocate, and once they define the positive outlook for a specific stock, a specific cryptocurrency, or commodity for the next 6 months, they systematically absorb large amounts of supply. And this happens way before other market participants. So this is a systematic process. It takes months for institutions to acquire a large quantity of a stock. This is not something that you can do in one day. They conduct a campaign. When large institutions absorb the supply of a stock, the stock becomes scarce, and then other market participants are forced to raise their bids and compete with each other. Wyckoff himself used to say that even though the CO types are mainly institutional traders, not all the institutions are necessarily on the right side of the market. And think about today's market. Money managers working in investment banks can make mistakes, like you, like us, and they are competing between themselves. Sometimes we feel that there is a very simplistic view of the composite man as a form of conspiracy made by a few funds that are always successful in each trade and looking to trap retail traders. This is a totally wrong idea. Remember, the real competition is not between institutions and the public. The public has limited funds. The real competition is among institutions themselves. So for this reason, we talk about strong hands that are positioned on the right side of the market and weak hands that are positioned on the wrong side. Strong hands could include CO types, like institutions, and they can even include retail traders that are able to identify the emergence of the uptrend and are making profits. So retail traders that are trading along with smart institutions. So our goal as tape readers at Wyckoffans is to study the footprints of the CO and be part of the strong hands group. Most of the time, the biggest CO types focus on long-term plans. So these large institutions slowly buy shares of a stock, planning to hold it for at least a year or sometimes even many years. Institutions are active in the market every day, but on a daily basis they are mostly adjusting their portfolio rather than chasing short-term gains. The composite operators have a deep understanding of the market cycle, the business cycle. Think about the last 4 years in the stock market. CO types have bought tech stocks at discount during the COVID crisis. And then we had the first leg to the upside, where all these stocks were going to the upside and with really a lot of momentum. However, at some point, institutions were buying energy stock and commodities. So I remember that we had the first correction in September 2020, and this was the time where institutions were taking profits in big stocks like Tesla, just taking some profits off the table. They were reinvesting the gains in inflationary themes. So they were anticipating the inflationary pressure way before the official statements by the Fed. In the first half of 2022, the energy sector took the lead, while tech stocks were sold in a very aggressive manner. Then the cycle is reversed in 2023, and we have spotted signs of demand for commodities, gold, oil, way before the latest announcement by the Fed about the inflationary data. Remember, institutions are very capable when they have to anticipate macro trends. They move billions of dollars, so and they leave their signature on the chart. So we want to be able to recognize these signs on the tape. We want to track the actions of large institutions and align our trade with them. When institutions sell their position, they do it very gradually because they want to avoid crashing the market. Retail traders have an advantage, just have an advantage over institutional traders. Your size is small, you can move your capital much faster in a very efficient manner. So there is no need for you to liquidate your position over weeks and months. You can sell your holding in just 1 second. Now, if you are new to our community, please check out our free education game series, The Bias Game. So how does it work? This is a series of exercises where we present you with a trading range, and you have to determine whether it's accumulation or distribution by observing price and volume. So every week we publish a new game on our Twitter channel, and then we release the solution with a concise explanation. This is a good way to make small progress every week. Remember, consistency is key with this methodology. You can just spend 15 minutes playing this game and then compare your analysis with our explanation. So you can track your score, exercises, and you can identify your common mistakes. This, I think, one of the most important functionality. And this is totally free. So you can find this series on our Twitter channel right here. So please check it out. Now let's continue with our price structure analysis. So where do we start our analysis? First, let's examine the price cycle model. So what's the current trend? What's the current market environment? Who's dominating, bulls or bears? And then we apply market behavior analysis. Who is buying during a big sell-off? Who is buying in the late stage or the uptrend? Next, we apply trend analysis and pure Wyckoff analysis. So we want to recognize the change in behavior in character, Wyckoff phases, and events. So we review now these concepts one by one. So let's review the basics. This is a simplified price cycle that shows accumulation, the accumulation phase, the distribution phase, and the trending environment in between. During the accumulation phase, we look for signs of institutional activity, such as a big drop in price, followed by an increase in volume. The increase of volume is generally the clue of institutional participation, because these institutions have big size. They are trading with billions of dollars, and this is visible on the chart. So a trading range starts, and during this stage, as the trading range unfolds, we focus on our bias analysis. In other words, we look for clues of accumulation or distribution. However, knowing the bias itself, it's not enough to make money. Remember, the timing is essential. We want to catch the emergence of the uptrend right here. That's why we watch for Wyckoff events that are associated with each Wyckoff phase. As the uptrend matures and market conditions change, institutions may start selling off their shares for profit. So the unloading of shares could be a gradual process. They can take some profits right here, and so on. During the distribution phase, shares gradually shift from strong hands to weak hands. And this is leading to less orderly price action, and increased volatility. During a reaccumulation, on accumulation, generally we have this high volatility at the very beginning, and then a contraction of volatility. And the uptrend is very, very orderly. In the distribution, like this, the opposite happens. So we have increasing volatility throughout the trading range. And this is telling us that weekends are now the majority of holders of the stock. So the downtrend unfolds until the price tests a value zone again. And then the CO type accumulated the stock again, and the cycle can begin again. So this is a very simplified version. Let's now explore a more detailed picture. So we want to understand the transition from the downtrend to the accumulation phase, then the emergence of the uptrend, and finally the distribution. Each event has its own name. The first event is the selling climax. What do we see here? We have a panic reaction, increased volatility to the downside, high volume. Value buyers are taking advantage of the increased liquidity because they want to absorb the stock. Let me use the pen again. Here we are. So this first buying right here generally leads to a significant rally. And this rally is bigger than what we have seen during the downtrend. So this is the downtrend. We generally have this rally, rally, rally. This is the biggest rally since the beginning of the downtrend. We call this a change of behavior. So this is telling us that something is changing in the market. We still don't know if this is a reaccumulation, accumulation, distribution. We don't know. But we know that something is changing in the balance between supply and demand. As we move into the consolidation phase, the price will retest the selling climax again multiple times, generally holding around the level right here. And look at this. This is phase A. This is the first time we make a high low, and this defines the boundaries of the trading range. Then we test again the support, we test it, we test here. And that's the beauty of the Wyckoff method, that since the very beginning, we can expect a trading range right here, as we have a confirmation of the lows. In a trading range, bullish traders focus on breakouts, while bearish traders try to time breakdowns. So there will be many whipsaws causing uncertainty, confusion. The support of the trading range often sees high liquidity. So there are many traders that have their stop losses around this level. And very often we have in the structure, the accumulation structure, a second point of fear, where weekends are capitulating. And this is when smart money absorbs the final shares and completes the accumulation process. What happens next? We have a very good rally right here, a good volume. So this is a change of behavior. And this rally is called the sign of strength. Other institutions buy into the early uptrend. They want to ride the trend as long as possible. And so we see an increase in participation. So let's review the whole volume signature just to think about the participation of institutions. So we have increasing volume right here because institutions are buying into the panic selling. Then we have a contraction of volume. Around the support, we know that there's a lot of liquidity, so we generally have increasing volume, increasing participations again. And then we generally have this event. This is a mini climax, a mini panic event, in this case a spring, that we call second point of fear. After that, the participation increases because many institutions are ready to recognize the very early signs of the uptrend. So increasing participation on the way up. Then we have the uptrend. We have multiple reaccumulations, so multiple pauses on this uptrend, and finally the distribution. The distribution phase is the opposite of the accumulation stage. Value investors who accumulated at the very beginning decide to take profits. This happens right here. This is the preliminary supplies, the first selling that we are seeing right here. Then we have the buying climax, where generally traders, retail traders, are extremely excited, optimistic. The buying climax is followed by a reaction. And this is the largest reaction since the uptrend has started. So the distribution process generally involves multiple days of selling, with value investors selling to the strength. CO types generally sell in the top part, in the top half of the trading range. For example, look at this. This is the supply zone, and we will see this concept in depth when we will study volume analysis. So this is a supply zone. Institutions are loading their shares right here. Okay, and generally have an upthrust at the end of this process, so a last push to the upside, or we can even fail below the supply area. So both configurations are possible, and we study many variations of this. But this is generally the top half of the range, is generally the area where we spot suspicious signs of selling on the chart. So you want to pay attention to this area. And remember that recognizing the signs of potential distribution very early is crucial for protecting our profits. We'll explore this concept further with many examples throughout the course. So let me see if you have any questions. So please write down. Let's stop a moment and write down in the question box. Okay. I see. Can you go over crude oil again? Yes, we will analyze at the end of the session. So for now, let's continue with the educational material. So let's break down the trend with a more detailed picture, showing reaccumulation and redistribution structure. In this chart, each mini trading range represents either accumulation or redistribution with the same sequence of events. So we have right here stopping action, coast building, break out of resistance, and then continuation to the upside. Look at this. Another accumulation, stopping action, coast building, breakout, continuation. Stopping action, coast building, breakout, continuation, until we get right here to the distribution. So Roman has created a traffic light model that simplifies this visualization. You see here that the red areas represent stopping action. Right here, right here, right here, where the trend pauses for some time. So in the accumulation or reaccumulation structure, there are 5 phases. Phase A, right here, this is the stopping action, where the trend temporarily balances between supply and demand. Then we have phase B, indicated in yellow right here, where the absorption process continues, building a cause for the next advance. And in this phase, we have multiple failed breakouts, multiple uptrusts. And if you are a swing trader, generally this is the worst time to trade this instrument. Unless you are looking for very short-term opportunity to the upside and to the downside, we are just making money, extracting the profits, trading the small swings. This is the worst time to be active in an asset which is in a long, prolonged consolidation. So we could have high volatility in this phase. Generally, the volatility is high in the first part and tend to contract in the second part. Very often we have that. Then we have phase C. In this case, we have an attempt to break the support. We call this spring. Phase D, indicated in green, this is the signal that the trend is ready to start. Look at this. Remember the institutions that were buying on the way up. This happens in phase D right here. Okay, so phase C is just the spring that we have right here. Okay, let me rewrite this. So phase C, phase D. Okay, it's very small right here. You can see it. Now, the last phase is phase E, which corresponds to the uptrend. So phase E, it means that we are about the consolidation, we are already out of the trading range of the accumulation in this case, or in the in case of the distribution, we are in the downtrend. The cycle continues with another buying climax right here, followed by another accumulation, and so on, until we have the final terminal buying climax into the distribution. And sometimes it's not easy to recognize an intermediary buying climax. It's not very easy to distinguish this climax, and it happens to think that we are just dealing with a terminal buying climax. So we have to judge the forces right here. We have to look for signs of distribution or reaccumulation. Remember, the bias is generally evident in the second part of the trading range, not at the beginning. But we will see, we'll study many bias games, so I think that this concept will be more evident later on. Now, Let's see what happens in the distribution. So the downtrend mirrors this process with multiple redistribution. Look at this. So what we have here, we have an upthrust. So first stopping action, so this is the buying climax, coast building, and then we have an attempt to break the resistance, but this is just a failed breakout. Remember, who is trading right here? Strong hands are selling while weak hands are coming in and they are trying to support the stock. However, the demand by weak hands is a demand of poor quality, and this demand is not able to push price above this level. Okay? After this, we have a breakdown, which is phase D, a sign of weakness in the context of the structure, and the downtrend unfolds in phase E. So it's basically the reverse image, the mirror image of what we have in the accumulation stage. Now let me add that in the uptrend, things are generally orderly, while downtrends can be less so. For example, a pattern that we see very often is an uptrend with this orderly accumulation, which are very similar to the schematics. Okay, and then we have some form of acceleration into the upside to the final leg. In my experience, downtrend tend to be less orderly because weekends at that time are the majority of the holders that are supporting the stock. So we could have, for example, very quick moves with short term, like a first attempt to bounce. After this, we just fell down, break down. And if you look at crypto markets, downtrend are very similar to this structure. So instead of having prolonged consolidation, we just have a first attempt to bounce, followed by very weak demand again. And sometimes there's not even the possibility to have big structure. We just fall to the downside. Sometimes even like a vertical line. This is possible because weekends are dominating this environment. Okay. Any questions? What's the best time frame to use the price cycle? By Marengi. Well, great question. And we will see an application of that right now. So we are just doing that. So let's start with this. This is the monthly chart of Apple. They're massive charts, and we generally do not use monthly chart in our analysis. We generally use the weekly and the daily. That said, the price cycle applies to all the time frame, even 1 minute chart, okay? And we will see this right now. So let's focus on the left side of the chart. So we have this big structure. This could be seen as a big accumulation, a multi-year structure. However, we have to break down this whole trading range into several segments. And you can see that this is like, for example, this area is very different than what we have here. The volume is totally different. Look at this. And this area is very peculiar. Remember, this is a big shakeout on a logarithmic scale. And then we'll explain the reason behind this big shakeout. So we can divide this whole trading range into multiple segments. Initially, there's a very healthy reaccumulation phase after this very quick uptrend. Let's say that you are watching this in real time on a monthly chart, okay? What's the bias right here? Do you see any significant damage on this chart? So we will address this question later on, but for now, let's say that we do not see a lot of selling pressure right here. Look at this, price is able to reside in the upper part of the uptrend, of the swing, so we are not losing ground right here. So this is, at this point, this looks still bullish, potential continuation. However, the structure deteriorates in 1994, and we have increasing selling. The volatility is much higher. Look at the spreads to the downside. For example, let's compare the spread, the down spread that we have right here, with what we have here. Here we just have a first break, and then all the spreads are very, very low. Okay, this is the largest part since the beginning of the chart. So the volatility is increasing, is expanding to the downside. So this means that there are institutions that are taking some profits, and we go through a period where the stock is weak, at least temporarily. This weakness persists until 1996. What happens in 1996 in Apple? So do you remember the events of the stock? And there was a very popular name associated to this stock. So what happened in 1996, guys? This is the time where Steve Jobs returns with a new business plan. This new business plan for the company is highly praised by the institutions. So this increase of volume signature indicates a very aggressive participation and absorption between 1997 and 2000. So this rally, big rally that you see on this chart, it's a major sign of strength on the monthly chart. And just think about this, you are trading on a daily chart, so this big rally is very significant move for you on a daily basis. Just think about this. If this is a monthly chart, a monthly bar, you have a lot of momentum right here, so you can operate and just trade reaccumulation right here. You can look at this. The small pause is likely on the sorry guys. Okay, here we are. The small pause is a very small reaccumulation. You can go on the daily, you likely find a pattern like this. Okay, so it's a very significant uptrend that we have, and the subsequent breaking up action is very, very sharp, and this is due to heavy selling pressure from the bear market at the start of the new millennium. Look at this. This is very aggressive to the downside. And even strong stocks can face pressure during bear markets, as any market participants sell their best assets to offset the losses. And I think that this is very, very interesting, because we are still making a higher low on the monthly chart. Do you remember what kind of event it is? 2000, 2001. So this was a very bad environment for stocks. And by the way, we see that Apple is still holding around the level or the original reaccumulation, potential reaccumulation that we have identified right here. So we had identified the reaccumulation right here, then this fails, so we realize that the structure is much longer and the stock will take many years to create this structure. And what happens next? The majority of stock at that time, in 2000, were doing very, very aggressive move to the downside, especially financial stocks, while at the same time, Apple was still holding at support. So this is suggestive of strength, and we will review this concept later on. So we have many stocks in deep downtrend, while Apple is holding at the level of the original accumulation. Okay. What happens next? This chart presents another very counterintuitive concept. So look at this uptrend that occurs on low volume on the right side. What does it mean? What's happening right here? Is this bearish? So this is a question. Please reply yes or no. Please write down. So no, it's evident because we see that price is skyrocketing to the upside. So this is not bearish. And this is very counterintuitive because price can actually travel to the upside on low volume for weeks, months, years. So what's the reason behind this? So please write down your explanation for this move on low volume, that this uptrend that is sustained for years and years. So let's interact, guys. So what's your explanation? I'll give you a couple of minutes. So let me read all your answer. So I see less sellers in the market, then other comments. CO is not in the game. Interesting. Then another comment. Supply is not presented to the market. Very good. Another comment, low volume, low demand. Yeah, low demand, but what about supply? The supply is even lower. So price can travel to the upside on low demand and low supply, but buyers are still in control. Exactly, yes. Other questions, other answers, guys. Let's interact here. Yeah, due to supply and demand, low supply, buyers are willing to pay more. Okay, that's great. So we have a very good answers here. So remember, what's happening here? Basically, institutions have both on the way down in a very aggressive manner right here. So there's accumulation through time, there's a phase of accumulation on the way up, and they are still holding. In fact, even through the financial crisis, we have a higher low. Then we have a second stage where institutions are accumulating on the way up for several years. Look at this. And this is a fantastic environment if you are, for example, a swing trader. You can make so much money, not just campaigning, but even trading all this reaccumulation. These are very significant moves. Remember, this is a log scale. We always use log scale to display a very long-term trend. So basically, institutions have very aggressively accumulated the stock throughout the trading range and even on the way up. And if you are uncomfortable with this concept, institutions that are buying on the way up, please go and check out the crypto charts. This is a pattern that we've seen over and over on crypto market. And why this is very visible on the daily chart for cryptos? Because cryptos are very illiquid environment. So every time institutions, crypto funds are trying to buy on the way up, we generally have this volume signature where the participation institutions is very visible and price travel to the upside very quickly. Here we see the same concept on the monthly chart of Apple. So institutions are aggressively accumulating the stock in the early stage of the uptrend. And we have said previously that institutions are not looking for quick gains. They are not trading until intraday. We are talking about a class of participants, of market participants that want to be early in the uptrend, and then it's just trimming the position, cutting maybe right here, trimming some an amount of supply right here, and so on. So they are just adjusting their portfolios, but they are not selling the stock. They still have to have a stock like Apple in their portfolio. So we have accumulation on the way up, and then institutional price is decreasing, and price continues to go to the upside on low supply and low demand. And this is a very important one, guys. We will see many examples of this. Conventional technical analysts always repeat this concept. Well, a trend has to be sustained by increased volume. This is not necessarily true. In fact, we have for a decade, almost a decade, decreasing volume, but price going to the upside. And this was one of the important stock in the market. What happens at some point? We have an increase of supply, and that is the beginning of the end for the stock. Okay, but when the volume signature is still low, we can travel to the upside. Now let's look at the so just a quick break. So for those of you that are new to our community, you can sign up for our weekly free newsletter when we share the latest updates and announcement. And remember, the YouTube channel of Wyckoff Analytics has a huge amount of free material. So you can find there many long videos, very detailed explanation, past trades. There's a very interesting discussion called the anatomy of a trade conducted by friends, where you can see many examples of past trades, post analysis. We always want to post analyze our trades. We think that that's extremely important. And all this content is available for free, so it's a great starting point for those of you that are new to our community. Please follow us on Twitter. Every day we release our clips from the session where we analyze, for example, the S&P, gold, Bitcoin. So please follow us on our Wyckoff Analytics channel on Twitter. Now let's talk about behavioral market analysis. Behavioral market analysis is the study of the behavior of different classes of market participants in the context of the price structure. So when I refer to different classes, I'm talking about distinct groups of institutional traders who operate within similar timeframes and employ similar trading strategy. Okay, So let's write this. Similar strategies. We will explore these groups in depth today. So we can make the first broad classification between weak hands and strong hands, okay? So this is very simplistic. We have seen before that the price cycle shows extreme points of fear, extreme points of excitement, and we generally have the capitulation in the early stage of the accumulation. Sorry guys. So this is the maximum point of fear in the downtrend. And generally this phase, weak hands are capitulating, while strong hands are buying on the way down. And strong hands can buy on the way down as the downtrend stops and on the way up. However, at the very beginning, there's a lot of panic selling, and they're buying, they're absorbing the stock on the way down. Institutional trend followers. So we have first contrarian buyers, then we have institutional trend followers, which are accumulating in the early stage of the uptrend. In the meanwhile, let's look at this stage right here in the middle. Weak hands can't sustain a long period without gains. Just think about this. You're spending time right here, you buy a position right here, and the stock stays here for a long time. Okay, this is unsustainable. So institutions can organize campaigns that can last for months, years, even decades. For a common investor, this is just too much. You want to optimize your portfolio. You just can't trade in this trading range, okay? It's very annoying. And the majority of retail traders will just leave the trading range at the end after so many attempts to have a breakout. So in this process, strong hands are accumulating more and more supply, while weak hands are gradually leaving the market. So we basically have this peculiar withdrawal from the market of weak hands, and at this point, the stock is ready to go to the upside. Because just think about this, weak hands tend to sell on every kind of panic opportunity. At this point, the majority of the stock is firmly held by strong hands. So at this point, even the selling coming from the overall market condition can create just a limited damage. The volatility contracts, we have small downspread and so on. Okay, and at this point, we know that the main force behind the Sinus trend rally is often represented by the institutional trend followers. So their strategy is to look for emerging trends. So we have a class of traders that are contrarian traders. They buy right here, so that they buy right here. And then we have institutional trend followers, that are buying on the way up. So this is another group of traders which want to buy the emergence of the uptrend. So they are not interested in absorbing the supply on the way down. They just want to trade the very early beginning of the uptrend. Sometimes they could be active right here. Sometimes they could come a bit later on, like on the reaccumulation stage. And remember that one of likely, I think this is one of the most powerful opportunity uh, is just trading the first accumulation after the original accumulation. So we have this big accumulation, then the first pause. This is one of the favorite setups of Bruce. Now let's continue. So we see that there are there are institutional trend followers that are looking for emerging trends. So they want to be very efficient on their trading. They don't want to have a losing stock for a lot of time. In other words, these institutional managers can't afford 6 months of inactivity. 6 months, and I say 6 months because this is a very common period for many money managers. 6 months where price doesn't make any progress, and this fund manager are under pressure to deliver strong quarterly performances. So if let's say that they are holding it to a position that is not generating gains, this institutional manager risks losing clients, because clients compare the performance of their fund to that of their peers, and at that point they may question why the other funds are gaining 10% and you are just making 5%. Because I have many positions like this. Fight. So this manager know very well that if their performance is not up to their peers on the market, they could be fired and replaced by other money managers that perform better. So these are different types of institutional market participants compared to value investors. Value investors are generally the larger plays that can swoop the supply at the bottom during the panic. These are the largest operators. They can remain inactive for many months, even years. So these value investors are able of withstanding periods of time without immediate gains. Institutional trend followers, on the other hand, will sell those positions that do not generate gains for a couple of quarters generally, and then we basically rebalance their portfolio. So they have quite kind of quick rotation every 6 months from one asset class to another. And just think about what we said previously about the overall rotation from tech stocks to energy, and then back to tech, and then again back to energy between the COVID crisis and today. So we generally have this rotation. So value investors are buying for the long term. Institutional trend followers have a much shorter period of rotation. Okay. Now let's see a slightly more detailed picture. So you see here the strong hands buy at the bottom and at the emergence of the uptrend. So we have buy on the way down and buy on the way up. And remember, not all the successful traders have to enter the market at the absolute lows. This is a very common misconception among retail traders, that they feel that they have to enter the market at the very bottom. Actually, many professional traders will enter the market as the trend is beginning. in this area. So during the initial stage, they don't want to be exposed to the stock at the beginning of the accumulation stage. Okay. In fact, there are many methods that are based on like a moving average, and we look for, if this is the moving average, we look for this segment where price is touching the rising moving average. So very simplistic methodology. Okay. Buying on the way up. How many of you generally prefer to buy the support set up like this, and they are scared to buy something like this? Please vote and say the truth, guys. So A or B, vote A or B. In your experience, in your trading practice, how many of you prefer a setup where they have to buy on the way down? Write down, guys. So I see both A and B. This is very good. B, B, LPS. Okay, I actually see that the majority of you love trading B. And I think this is correct because this is the point where you generally have a much higher probability of success. However, I see that many traders, especially beginners, like they feel more confident, more comfortable on the support. But this is generally a very risk point of entry, unless you are already trading in the established uptrend, something like this. So you have a spring right here, already have leadership in the previous uptrend, the accumulation, and so on. And David Weiss, a great Wyckoffian, used to say, trade the spring in the uptrend. Do not trade the spring in the downtrend because they have a much lower probability of success. They fail right away. So please, we have to identify the general environment for the uptrend first, and then we look for opportunities like springs around the support. But my favorite setup generally occurs right here, as we are leaving the uptrend, or even the first reaccumulation after the original accumulation structure. Then let's continue with our analysis here. As the uptrend matures, all these operators that have accumulated their position become inactive in the stock. They have position in their portfolios, but they have no reason to touch it. They just focus on other opportunities. And remember, there's a strong rotation in the market, so you could have, for example, traders that are buying right here, they become inactive for some time, and then they just look for other opportunities, other potential breakout. Okay, so they will be inactive in the stock, they will be active in other areas of the market. So very simple. So at this point, the uptrend can continue, and look at this phase, the yellow segment, but we do not see massive institutional presence anymore. And this will be reflected in the volume. So the same concept that we have seen before for Apple. Volume is decreasing, institutions are inactive, but the price can still continue to travel to the upside for months and months, even years. Okay. So at this point, the institutional presence is very low. Only later in the distribution stage, we will see high volume again, telling us that the suspicious exchange of shares is taking place. So volume increases generally in this stage. Any question about this? Okay, let's continue. So let's see a practical example. So this is the chart of Apple that we have discussed before. I would suggest you to focus on all these volume increases. So look at this. Look also this area right here. What's happening right here? The institution participation is increasing. You recognize this just looking at these big buying waves. Okay, this is a monthly chart that we've seen before. So we have the first buying wave right here at the very early beginning of the uptrend. So this is still a sign of strength, a major sign of strength followed by a major breaking up action. We will see these concepts in the next session. Then we have a second wave, buying wave by institution, and we see this massive volume signature. Then we have a third leg to the upside, and here the volume signature is still high when you compare this, for example, to this, but it's not as much, okay? So it's slightly lower, and this is happening because the smartest institutions have bought the stock in this area. Now they are gradually becoming inactive. There are always other institutions that will be laggard, so will join the uptrend later on. So we still have institutional participation, but it's much lower than the spikes right here. And then we have this stage where institutional presence is very low. So institutions, they still have this stock in their portfolio, but they are not just touching their position. They have it, it's a part of their portfolio, it could be 3% of their portfolio, that's it. They're not touching it, so they are not selling. At this point, the participation that we have, just retail traders and so on, they are still able to make money trading the stock to the upside. So this is not the reason to not participate. Absolutely not. This is wrong. You can still participate to the upside. And just think about the last years for Apple. They've been very, very good. So from the trend following perspective, the uptrend can continue for many years on low volume. This is very counterintuitive, but we have just explained this concept. Okay. The same concept, and now I'm replying to one of your questions, can be applied to shorter time frames. So this is a weekly chart. And you can see here the original accumulation that we had. So basically, this is, okay, the same chart seen on the weekly. So let's break down this whole accumulation structure. So this is the point 97 where Steve Jobs come back and the stock gets some love by institution again. And look at all the dramatic reaction that we have. For example, right here, we have high volatility. However, and this is a weekly chart, so it's really very significant reaction right here. Just think about this. You were looking for a breakout right here, and then we fell back into the support. So there's definitely some volatility, but this volatility does not produce new lows. This concept is very important. We always want to look for the result of the swing. Sometimes we are just impressed by increasing volatility, high volume. This is the character which could be very bearish, but we have to pay attention to the actual result. So the character of the reaction is bearish, but the result is bullish. So Roman has created this way of saying looks bearish, acts bullish. Okay, so this is what's happening at the very beginning of the accumulation stage. Okay. Then in 1998 we have a very strong rally, and look at the consistency of the demand right here. When we talk about the consistency of demand, we just want to say that we have multiple bars, so several bars right here, first bar, second bar, consecutive bars where we have demand, high demand. And this is very constructive. So every time you see this signature where the volume signature, the demand signature is quite elevated for several consecutive days, we know that institutions are buying into the stock. And this is totally different than what we had here, for example. We're just look at the beginning of the accumulation structure right here. Volume spike, volume spike. So we do not have many consecutive days of buying. Even this rally is a bit suspicious. Okay. While here, for the first time, we have many consecutive up days, good bars, look at the spread, and at the same time, the reaction are very limited. Look at the spread, very small spread, very small spread, and volume signature is decreasing. Just think about this. This is the highest volume signature right here, and it comes with a high effort and high result to the upside. Then the supply signature decreases. Look at the down bars right here in red, while the demand continues to be consistent for several, in this case not several days, but several weeks. So it's a quite significant period of time in the market. And look at this big reaction. So we have this reaction is basically caused by the selling pressure of the market, and this is a principle that we will see many times, guys. So basically, when the overall stock market it's going to the downside, and we have a very pronounced correction, like the devastating correction that we had in the S&P at that time, even the strongest stocks can be sold. And this happens because institutional money manager, they have to trim the winners in order to cover their losses. And so even the strongest stock could be affected temporarily by the big selling that we have in the market. We call this the gravity of the market. Okay, but even here, when let's say that the chart stops right here, we know the future for this chart. Okay, but how would you define this price action? Look at the volume right here compared to the original lows right here, this resistance. Do you see a big result to the downside? Yes or not? So we know that the price will go to the upside. We already know this. At this point, let's say that you are trading right here. What's the result to the downside? We have a high effort right here, but what's the result? Please write down, guys. Okay, see the first questions. It's still a higher high. Great. A higher low. So we have a higher high right here, and all this aggression to the downside caused by the gravity of the market, but we are still making a higher low. So looks bearish. Acts bullish. If you are trading this real time, you of course you want to see some kind of confirmation like this. So you are trading this, for example, so you want to trade breakout around this level, then you can add your position around the resistance and so on. Okay, but this is still a higher low compared to the original value zone, and after that we made the second higher low. So you see that the contraction of volatility is happening in front of your eyes, and if you think about this, you have reaction number one and reaction number two. This is the test. This reaction is the test of the first reaction. And in the Wyckoff methodology, we often see this concept in play with action and then a test. So we have the first reaction and then a second reaction in the same zone that is showing less volatility, less volume. So we know that buyers are in control. This is a very important concept. We will see many applications of this idea. Now, let's apply the same concept to shorter time frames. So right here, we have a 2-hour chart. And we see the same principle. So the price cycle, I'm replying to a question that I've seen, can be applied to all the time frame. The monthly, the weekly, the daily, 2-hour, 5 minutes, and so on. So we want to be able to recognize the accumulation, the reaccumulation, distribution, the downtrend, or all the time frames, and we'll be able to do that. And look at this structure, for example. We have the same principle. So buying on the way down, right here, high volume, automatic rally. This rally is the best rally since the beginning of the downtrend. Look at this. And then price falls below the support right here. So we create this trading range. So selling climax, automatic rally, secondary test. We establish the boundaries of the trading range. We'll review these concepts in the next session. But what happens next? The volume signature is decreasing. At the same time, we have very good up spreads. Look at the spreads to the downside. They are very small. Okay. And the demand comes back. Same principle, reaccumulation right here. The volume signature is decreasing again. And then we have continuation to the upside. This is a very tricky pattern. I see this pattern many times in the crypto market. So basically, in the first stage of the uptrend, we have this very low volatility environment, but then in the second stage, we see some volatility coming in. So first structure, so we form this mini uptrend channel, then we break to the upside, failure, so uptrust, and we go back into the support. So this is not a trading range. This is a mistake if you call this a trading range. This is still a local uptrend. The actual trading range could be identified in this area if you want. So this is the first selling. These are institutions that are taking some profits off the table. Then they are inactive right here. Sorry. And then we have selling into the excitement. Look at the volume signature. So there are many traders that are just eager to buy this breakout, but the breakout fails right away, and then increasing volatility, and then again some kind of absorption right here. In fact, we have this very significant rally. So we want to be able to identify all these nuances on the weekly, on the monthly, on the 2 hour, and so on. Okay, and for each time frame, we generally have different operators that are, for example, on this time frame, 2 hour chart, you will not see CO types that are trading like on 5 minute bar. No, this is incorrect. CO types are looking for big moves in the market, not for shortened time frame. But the market is fractal, so we will still have strong hands that are buying on the way down, then strong hands that are buying on the way up, and so on. So the same principles could be applied to several time frames, and we will discuss many market environments. For example, I'm kind of specialist in crypto market, and in that market you have a different class of operators. Crypto funds are a bit different, behave in a slightly different manner than a conventional institutional money manager. They have different kind of different style of trading, but the principle are the same. Okay, so you just have to adjust to the specific time frame and the specific trading environment. Now let's discuss the market participants. Any question about the previous chart, this 2 hour chart, guys? Please write down if you have any question. Okay, great. So let's continue with the market participants. So on this table that Roman has created for us, we see there are several kind of market operators, such as CO types and trend followers. So our CO type, the composite man, is generally an institutional contrarian investor, also known as value investor. Okay, and you see right here, value. This is the methodology that they're applying. So they hold huge positions for the long term, size huge, and look for short-term liquidity to open and add to their position. So they analyze contrarian sentiment and consider opening position when the market is extremely bearish, if they want to buy, based on their models. So they just have, think about this, these giant operators define their value zones at specific prices. Their research are showing that a specific asset, or generally a whole asset class, is very promising. The market condition, the business cycle condition could be very favorable for the next 6 months, years, and so on. So after they have identified the value zones, they wait for a big correction, a big reaction, a big panic selling to accumulate how much supplies is possible. So what's the main limitation of these operators, guys? They still have like a weak point in their behavior. Please write down. I see here some answer. Please write down, guys. Their biggest weakness is the size itself. First, because their size prevents them from opening and closing position in a single day, like retail traders can do. Second is the fact that the big size means that you can't hide your trades. They will be visible. If you are buying, for example, a mid-cap stock on the way up, and you have a big size, you will cause high volatility to the upside for the stock, and you don't want that. You want to buy a very stable price that you have previously defined as your value zone. Okay, so this is their weakness. Okay, their size is very huge, and as Wyckoffans, we can advantage of this because their footprints will be visible on the chart with a volume, high volume. Okay, so when you see a very high increase of volume, you know that there's institutional participation increasing there. Generally, they prefer very low turnover of their portfolio, and this is because they want to keep tax implication very low. And think about this: private investor can quickly rotate from one stock to another, while value investors use different approach. So value investors basically identify a good sector, a theme. They build a massive position in the best 2, 3, 4 companies in that sector, generally large caps, and they hold the stocks for months and years. So their edge lies in their long-term horizon, deep knowledge of the market, and ability to spot these long-term trends. So as deep readers, as Wyckoffans, we can spot their presence on the chart, looking for extreme volume at the points of liquidity. Example of value investors are BlackRock, Pinko, even Warren Buffett. Okay, very popular example. Then we have institutional trend followers. In this class, we can find hedge funds, investment banks. Their point of entries are completely different. Their time horizon is more cyclical than secular. So we have seen that CO types generally look for secular moves, while institutional trend followers are interested in cyclical moves. Okay. So extremely important for them to recognize a break of the trend, a break of the accumulation structure, a break of the trend, and so on. So they focus on the shift from one environment to another. While performance is the driving force for institutional money manager, this can also create limitation for them. They are constantly compared to other funds, which can sometimes lead to a herd mentality. This is very important. We always think about retail traders as the herd. No, institutional trend followers can behave as a herd. They are often look at the same researchers and so on. So there are times that when they can be wrong. Okay. Also, for retail traders, can be challenging to understand the mindset of institutional money managers because they have to follow many rules that just a single trader they don't necessarily have to follow. Then we have professional traders, and we are talking about essentially small boutique trading firms, registered investment advisors that manage savings for wealthy clients. For example, 60 millions, relatively low compared to the billions of big funds. So these trading firms usually adopt multiple strategies. They focus on short-term swings, and their system generally trade two kinds of opportunities. They look for momentum trades, and they look for mean reversion trade. So basically, momentum is where you have an accumulation, the uptrend. So you have a well-established uptrend, okay? Or they act on the boundaries of a trading range. So they will be right here, they will be right here, they will be right here. They will be wrong at this point. So they basically have leverage position to the downside and leverage position to the upside. The pitfall is the high turnover of trades. Sometimes the short-term focus encourages them to have a very, very fast turnover. Sometimes this turnover is very fast, especially when you have the possible uptrend which is establishing. Okay, so a good part of this group tend to ignore opportunities that present much better gains in the long run because their system are built for a quick turnover. And I've seen many examples of this kind of professionals in the crypto industry, since we know that in that market, the algo trading is extremely, extremely popular. And there are so many opportunities there. But sometimes I see many traders that are focusing on short-term opportunities, and they miss the big, big run, bull run that we generally have for cryptos. You know that in crypto land, you can have 10x move in just a couple of months. So they focus on the short-term environment, and sometimes they miss the big picture. Not all of them, of course. So there are strategies where there are moments where the mean reversion trade wins, especially in bear markets. And in bear markets, basically, if you want to make money, you have to trade all this redistribution. Okay. So, for example, this is a classic example of the opportunity you can have if you are a professional trader in the downtrend. You identify an extreme oversold condition, you open the long position right here, and generally the first rally is the best rally during the distribution. So you have something like this, you are making money right here, you close the position, and then you go away. Okay, so just this small swing opportunity. And then we have retail traders. And the majority of retail traders usually have access to poor quality information and data, and their tactic is basically momentum. So momentum strategy. And this is not a bad thing actually, because if you are a retail trader, you can just focus on your opportunities. So you want to have momentum on your side. Okay. But this is also a limitation because sometimes you are not able to recognize the right environment for momentum strategy. Let's say that the whole market is going through a consolidation. What happens right here when the market is here? You can have a very, very strong stock. You look for a continuation pattern, so momentum strategy, contraction of volatility, breakout, very classic setup. And what happens next? The market is falling. So this setup fails and you are back into the trading range. So if you are not able to recognize the right moment where you can use momentum strategy, you are still going to lose money on setups, high quality setups like this. So this is a deeper understanding that we want to develop as Wyckoffians. Now that we have discussed these institutional types, we can look back at the price cycle and think about the behavior of these participants. So all these market operators are not active at the same time. Most of them have long periods of inactivity. For example, value investors do not move their capital during uptrends. They can make some profit here and there, but once they establish their position, they become inactive. Institutional trend followers are not very active during the early stage of the accumulation. So these are value buyers. These are institutional trend followers. So they wake up when we see the first emergence of the uptrend. And we have to say that they're generally not very active even in the reaccumulation, especially if you are talking about daily chart. Okay, they generally are very active at the beginning and then they become inactive. So ETF active right here and then inactive. Many professional trading firms that focus on mean reversal trades will be active only right here on the extreme of the uptrend. So they look for levered trades to the downside and to the upside. So they focus their activity on these extreme boundaries, or they can active here, here, and for example right here, they are just inactive. They are inactive. Okay, and this is very important. So we have different market operators operate at the same time, but we want to recognize their behavior and the moments we are really active. And this is the daily chart of Apple. There's an important, very important nuance. The background of this chart was an unfavorable market for many stocks, but Apple was holding much better. And look how every time we see high volatility in the accumulation process, right here, institutions are buying the stock. Look at the impressive volume signature. So this is value buying. This contrarian buying does not happen only at the lowest level trading range. We have the sign of strength that we have discussed before in the middle. And after that, we form a new value zone. So this is the first value zone that institutions, big institutions, CO types have identified at the very beginning. And then they identify a second value zone where they want to buy every time the price, every time they see the opportunity. Remember, they can't buy large position only on the way down. So they buy during all this reaction, these mini panics, because these are the moments where a lot of liquidity is available and they can operate only when they see a lot of volatility in the market. So this value buying at the high level, the fact that we are switching to a value zone which is higher than the previous value zone is extremely bullish. So this suggests that the stock is very strong. So we have already traveled from $40 to $50, but contrarian investors are still willing to accept higher prices. Okay, and this is an indication that they have a very strong conviction to build a large position. Institutional trend followers will come only later. This is another nuance on this chart. So notice how the initial selling by contrarian operators occurs very early, as we can see in the extreme volume signature, but we continue to make higher highs and higher lows for some time. Okay, so this is typical of leadership assets that have strong momentum. So we need to train our eyes to recognize the situation, which could be very misleading. When you see this huge selling and then continuation, we still have no evidence that this is distribution. It could be profit taking for another accumulation, but we must mentally prepare ourselves for that potential switch that can come at some point very quickly. After we make a higher high, supply comes back quickly, and this volume increase does not produce any significant progress about the previous high, indicates that someone is selling into the strength. So why do we see all this volume signature right here and we don't see any progress to the upside? What does it mean, guys? Quickly. Why we see all this volume but no result to the upside? Please write down. I see the first comment, opposite info. Yeah, great. Supply is present. Absolutely. Great answers. And so there's a force that is stopping the demand. So basically supply is coming to the market and is consuming the demand. So there is contrarian selling. So these are, in the first stage, we have this big selling, and it's very evident in the volume signature. And this is basically the selling by the CO types. They are contrarians. They need to sell when there is a lot of liquidity available in the market. At this point, we know that a lot of traders are coming to the market. They are attracted by the extreme momentum of this asset. And then they take this opportunity to unload a part of their position. After this reaction, look that the stock is still able to commit above the high, at least temporarily. So they are selling their position at the right moment without depressing the prices too much. This is their goal. They don't want to push price below a certain threshold because they still have other chunks of supply that have to unload to the market. Okay, and this is extremely important. So they move very slowly. They have to unload this massive amount of supply, and they have to go to do this almost secretly. Okay, what happens next? At this point, the CO types are already selling, but institutional trend followers are still buying until their buying is not enough to push price above the previous resistance. At this point, just look at this. We have just a very marginal commitment for a couple of months about the high, and then we fell back. At this point, institutional trend followers are capitulating because they were buying right here and they are already unprofitable. So as the downtrend is emerging, they are capitulating and they are progressively selling their position, selling on the way down. Okay. They just want to get out, and they are not weekends, even if they are a bit later than acting later than the CO, because there are institutional trend followers that are buying here and they are totally wrong. But there are many institutional trend followers that, for example, have bought right here. So it makes sense for them to take profits right here, and this is still a very decent trade. Okay. They're still making money. They are not unprofitable, even if they are not selling off the top, if they are not recognizing a sudden shift. And this is our goal, by the way. We don't want to be extremely precise at the bottom or at the top. We want just to enjoy the uptrend or the downtrend. So this will be an important lesson, and we'll see many practical application. So for those of you that are students in this class and will join our class in general, the assignment for this week is to read Jim Forte article and complete the quiz in your student profile page. And this concludes today's session. Thanks to all the guests that have joined us today and learn about offering the Wyckoff method. If you have any questions about the course, do not hesitate to contact us as Wyckoff Analytics gmail.com. So visit our website. You will find many offerings there. You can register for the whole 15 webinars at once or opt for a payment plan. And if you plan to rewatch parts of this session, today's session, as you know, was an open door session, so this video will be uploaded on the Wyckoff Analytics YouTube channel. Any questions, guys? So let's quickly review the box side. Okay, this discussion is very enlightenment. Thank you. Thank you, Malik. Great session. Okay, so guys, that's it for the current week. Thank you, everyone. Look forward to seeing you again next Monday at 3 p.m. And for those of you that are interested in joining the course, registration is still open. Thank you, guys. I look forward to see you again in the next session. Bye-bye.